So Federal Reserve gets created. We're doing okay. You have the Roaring Twenties, right? The stock market, all that, and then the Great Depression hits.
Great Depression, total disaster,
Total
right?
disaster. But it didn't start out as a depression.
Yeah, and that's what's so interesting about the Great Depression, that it was a normal recession going into it. But what happened was that the Federal Reserve at the time, the Federal Reserve was, we had one at that, right? We had a central bank. So you're thinking, well, why wasn't the Federal Reserve able to stop this? Well, kind of the consensus among historians is that there was infighting between all the different Federal Reserve branches and the Central Monetary Commission in Washington, D.C., because there's a guy by the name of Benjamin Strong who was the first, head of the central bank who had passed away before that. So they weren't able to come in and stop the Great Depression. But what it was is you had a recession that then turned into the Great Depression because of literally thousands of bank failures, and people lost their savings, and that just turned it into what it was.
Right. And so part of obviously the Great Depression, I think everyone remembers, is this terrible day on the stock market. And that, and combined with the bank failures, you end up with something called the Glass-Steagall Act.
Right. So if you think about the financial crisis we just dealt with, the Dodd-Frank, well, Glass-Steagall was basically the Dodd-Frank of the Great Depression. So you went from a relatively unregulated, to a certain extent, banking industry to a very, very strictly regulated bank industry. And what Glass-Steagall did in particular is it separated a bank's investment banking activities, which is issuing bonds, underwriting stocks, things like that, trading in securities, all those types of things, from your commercial banking activities, which is just, taking deposits and making loans. And what's interesting about Glass-Steagall is that there is, this is an analysis I've come across in multiple books. There is reason to believe that it was really backed in large part by Chase, which is now part of JP Morgan, right? And by the Citibank of New York, which is Citigroup. And the reason they backed it so much is because they had large commercial banking activities, large depository activities, but JP Morgan, which at the time was the leading bank in the country, was really largely dependent upon investment banking. So they knew that if we can separate JP Morgan's investment banking business from its commercial banking business, we'll be able to take the lead. And that is at that point that Citigroup went from being kind of the second to third largest bank and the second to third largest player in the industry to really dominating it for many decades after that.
And this is why people think bankers are sneaky.